Hello there, welcome back. Okay, so we continue from where we left last time, as promised. This is just the part 2 of the lesson 5. We're still talking about the basic accounting principles. We talked about a few of them in the part 1 lesson. If you haven't watched that one, please do watch before you continue with this video, because this is just a continuation from part 1 of the same lesson. As usual, you're with me, Goodson Charlie. Let's go. So what's the next basic accounting principle? So we're going to look at the economic entity principle. The economic entity principle. What does this principle talk about? So the economic entity principle dictates that a business financial activities must be kept strictly separate from the personal financial activities of its owners, shareholders, or other businesses. So basically, this principle recognizes a business as an individual on its own. So we shouldn't mix our personal business transaction with that of a business. It is a very important principle because it will also help us when we are recording the transactions of a business, and we will be able now to separate those. We will be able to tell how to separate the personal transaction from those of a personal ones. Okay, let's look at the example of a demonstration of how this principle works. So for instance, we have a small business owner who pays their personal rent using the company's checking account. He uses the checkbook of a company to pay the personal rent. So to adhere to this principle, to the economic entity principle, the accountant must record this transaction as a withdrawal or of owner's equity, also often referred to as drawings. And if in some cases, maybe you can record it as a dividend that you are paying to the owner of the business, rather than a business operating expense. It would be a mistake for the accountant to record this transaction as an operating expense, because it is an expenditure that does not in any way help to generate the revenue of the business. It's a personal rent. So this has to be kept separate from the business. So this transaction will be recorded as money that has been moved out of the business. Yeah, so that's basically what the economic entity principle dictates us to do. Okay, moving on. Let's now look at the famous going concern principle. Going concern principle is another important principle in accounting. Okay, so the going concern principle works on the assumption that a business entity will continue to operate for the foreseeable future and will not be forced to liquidate its assets. Why is this important? There are certain transactions that are recorded based on the assumption that the business will continue to operate in the foreseeable future. The foreseeable future in this case, I would safely describe as a period of more than 12 months from the reporting date. Let's look at an example to demonstrate how this principle operates. So because a company is assumed to be a going concern, it can record assets like buildings and equipment at cost and depreciate them over many years, since you are assuming that the company will continue operating. So if the company were to be expected to close down soon, its assets would have to now be valued at the immediate liquidation value. Immediate liquidation value, simply meaning what they could have been sold for quickly, the fair value, okay, the market value. which is much usually lower due to the depreciation. I'm not going to talk much about depreciation and the like. We are going to look at special consideration items later on, where we'll cover, among others, depreciation. So basically here we're only saying when recording transaction, we assume that the business will continue to operate, because if it won't continue to operate, there will be some changes in how we record the transaction. In part, this would also explain what we talked about, the historical cost concept. We said we continue to carry the value of assets at historical cost on the assumption that we will continue to operate. Otherwise, if you are if we were to assume that it will close down soon, then we'll have to determine the value that the asset would immediately be sold for. Yeah, okay. So that's what the going concern principle is talking about. And then we also have the materiality principle. So the materiality principle requires the financial statements to disclose all information that is important enough, mark the word important enough, to influence the judgment or decisions of a reasonable user. We are only looking at the information that is relevant, that is capable of influencing the judgment and decision of a reasonable user. For minor or insignificant details, those ones may just be aggregated or treated simply. For if something is, if an information is material, it simply means it is capable of changing or affecting the judgment of the user of that information. While it is immaterial if it doesn't change or affect the decision of users. Let's demonstrate it by looking at this example. So let's say, for example, a large corporation buys a $20 stapler machine. Technically, the stapler is a long-term asset that should be depreciated over its useful life. However, looking at the value now, because the $20 is immaterial amount relative to the company's millions in revenue. So the accountant will simply expense the stapler immediately for simplicity. Yeah, we don't have to carry the stapler machine, which can just be expensed as part of stationery for 10 years, because that value cannot change the value of the user of information. Conversely, if a $20,000 printer would be considered now material and must be capitalized and depreciated. So the difference here between the 20 and the 20,000 is that the 20,000 once treated as an expense, we will know it will reduce the profit, but now looking at the amount that it will reduce the profit by is simply smaller as compared to the 20. So 20 is immaterial while 20,000 is material, if this example is anything to go by. So that's what the materiality principle is all about. Okay, going on, let's look at now the consistency principle. As the word itself suggests, the consistency principle requires a company to use the same accounting methods and procedures in all accounting periods without changing. If a method is changed, the company must justify the change and disclose its impact on the financial statements. Okay, let's look at the demonstration by looking at this example. A manufacturing company chooses first in, first out, or FIFO method for valuing its inventory. You come across these things when you look at cost accounting. So the consistency principle requires them to use FIFO every year without changing. They cannot switch to last in, first out, LIFO method. the next year just because it results in a better tax outcome, unless they have a valid reason and they have to disclose that reason. They have to disclose the change transparently in their financial report notes. So this is about transparency and comparability. So if consistency principle helps to ensure that the financial statement for different periods are easily comparable because you are using the same accounting methods and procedures. Okay, let's move on. Another important principle is full disclosure principle. This principle mandates that all information relevant to users' understanding of the financial statement should be included, usually in the notes accompanying the main financial statements. Usually, financial statements are accompanied by explanatory notes, which describe in details some of the treatment that cannot be described in the statements using figures. So this principle requires a full disclosure. We have to disclose any information that is capable of affecting, that is material, that is capable of affecting the decision of the users. Let's look at this example. A company is being sued for significant amount of money. Even if the case hasn't been finalized and no liability has been recorded in the main balance sheet numbers, the company must describe the nature of the lawsuit and the potential financial impact and management's best assessment of the outcome in the footnotes in its annual report. So this will prepare the users, especially the investors, to anticipate this lawsuit in the future so that it doesn't come as a surplus. So that's what the full disclosure principle demands us to do as accountants. So in conclusion, you would see that this principle simply provide now the foundational theory that underpins specific accounting standards issued by the governing bodies such as the International Accounting Standards Board, IASB, ensuring consistency, transparency, and comparability in all financial reporting. As we earlier indicated in the first part of this lesson, we said these principles form now the basis on which the regulatory bodies now form what we call the International Financial Reporting Standards or International Accounting Standards. Yeah, so far, so these are the main, the basic accounting principles that you must be aware of as you practice your accounting, as you progress in your accounting journey. So these principles will be applied in many ways as we do prepare our financial statements and justifications. So this marks the end of lesson 5, part 2, and indeed the end of the lesson as a whole on the basic accounting principles. Thank you for listening. Watch out for our next lesson, and don't forget to comment and subscribe. Goodbye and thank you.